Welcome to today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra, and my partner and I are going to increase your IQ, financial IQ, with today's episode, where we discuss the one big, beautiful bill that was recently signed into law by President Trump. As I said in Elliott Wealth Management's mid-year economic update, not everybody agrees on various elements of this tax law. We view it generally in a favorable way. Have to see how it all plays out, of course, but we view it favorably. So I have with me Brett DiPasquale, part of the team here at Elliott Wealth Management Services. He and I work closely together day in and day out to discuss various aspects of the tax law. We're going to do this in two parts. So this is the first part you're listening to. I encourage you to listen to the second part too. But Brett, thanks for joining me today to discuss this important piece of legislation.
Yeah, of course. Happy to be here.
So let's start with the basics because this is a renewal of the tax law. At the core, it's a renewal of the tax law that was passed in President Trump's first administration. This was back in 2017. So let's start there and talk about some of the major elements of the tax law continuation or renewal.
Sure. So I guess the first thing we should both preface the entire podcast with is we're not CPAs. We can't do your taxes, but we can advise you on them. Is that fair?
Yeah, absolutely.
So jumping right in. So the biggest thing that the BBB or the Big Beautiful Bill is going to do is it's going to extend the tax cuts from 2017. So the big fear was that folks in the 10 or 12% brackets would have a substantial increase in income tax rates if the tax law from 2017 wasn't extended. So it was. So that really gives some relief to folks in the 10 or 12% brackets. So we also have to realize that the income tax brackets are gradiated upwards. So not all of your income falls into one bracket. The first part of your income falls into one bracket, and increasing slowly upward. So that's a good extension. I think it helps middle America and also those making incomes of around, say, 40 to $75,000 per year.
And let me add that my view, and I believe lots of academic research backs this up, is that the tax law in 2017 was tax relief for the vast majority of Americans at all income levels because it both reduced rates and expanded the back brackets, meaning that you stayed at lower tax rates for higher and higher incomes. So this was a very positive element of the 2017 tax law. And I am glad, I think the team here at Elliott Wealth Management universally believes that this is positive to renew this moving forward and making them permanent, where the 2017 version was temporary, set to expire at the end of 2025. It also spoke to Roth conversions, and I want to touch on that, Brett, because we do a lot of work here at Elliott Wealth Management, advising our clients when it's appropriate and how much might be worthwhile to convert to Roth. Can you talk a little bit about that?
Yeah, so converting to a Roth means that you're taking traditional IRA monies that haven't been taxed yet and moving them, paying your taxes on them, and converting them to a Roth IRA. So instead of your growth in the traditional IRA sense, where as much as your money grows, you still owe taxes when you withdraw money from those accounts. In a Roth IRA, it works exactly the opposite way. So as your money grows, money can be removed from that account and withdrawn from it tax-free, including the growth after the age of 59 and a half. So us at Elliott Wealth Management, we always like to advise in the right situation for clients to make sure they take full advantage of their lower tax brackets by filling them up, if you will. And then that way, let's say you have, and here's just a crude example. Let's say you're in the 12% bracket and you still have about $10,000 left of income before you go into the next bracket on top of that. It may be, and we work with your accountant on this, it may be advisable to take that $10,000, fill the rest of your 12% bracket up, and convert that IRA money over into a Roth IRA. Keeps your taxes lower, and then also long-term strategy wise, all your growth from that point forward is federally income tax free.
So next, Brett, I want to talk to you about the standard deduction. I have some thoughts on it, but why don't you kick us off and talk a little bit about the standard deduction in this tax law?
Perfect. So the standard deduction for 2025 is going to increase a little bit. It'll increase by about $1,500. So that'll also provide some relief going into the next tax year for both single taxpayers and married taxpayers. It's across the board, really. So it's increased from last year, just a small amount.
Yeah, so the thought that I had, which I think was largely underreported with the first version of the tax law in 2017, and I'm glad this continues this policy with a healthy standard deduction. Because if you're listening to this, I want you to appreciate that we all agree that the tax code is incredibly complex and it's gazillion pages long. But in 2017 and now continuing, this standard deduction means that 9 out of 10 Americans file their tax returns with the standard deduction, meaning a lot of the complexity in a tax code is not applicable to them. And their tax reporting, their tax filing is simplified because they take the standard deduction, because the standard deduction is high enough, it's healthy enough that it is advantageous to use that instead of all the other little things in the tax code that you might use for deductions. So 9 out of 10 Americans file the standard deduction. That's higher than it used to be. And it's a great aspect of the Trump tax policy, which is simplification, which I think was much needed and should be welcomed by Americans because we don't want to deal with this complicated tax code if we don't have to. So that's my soapbox explanation on the standard deduction. How do you like that, Brett?
I like it a lot, and I think everybody can agree that the tax code should be simplified.
So next, let's just touch on child tax credit because I believe there's an increase in the child tax credit. So let's touch on that.
Yeah, small increase in the child tax credit goes up $200 from the previous year. So small increase, but also across larger families could be beneficial. So not too much there, but at the same time, increases a little bit.
Yeah, and very friendly, right? It seems like good policy to give families a little bit of a leg up, a little bit of a tax credit because the cost of raising children goes up all the time. Salt deduction. Let's talk about that. This was something that created some controversy in the first version in 2017. So to set this up, everyone, prior to 2017, a filer could write off unlimited amounts of deductions for local and state taxes, including property taxes. It was unlimited. With the 2017 legislation, that was limited to $10,000. And a lot of people didn't like this. This certainly impacts high income earners, wealthier people who tend to pay more in state and local taxes and also tend to have higher property taxes. So it was a way to limit their ability to deduct on their taxes. This, of course, if you think about it, affects some states more than others. States like Illinois, California, and New York, as examples, were hurt by this more than lower tax states such as Florida, Texas, and the South. So what was done in this bill as a compromise was to increase the 10,000 to $40,000. So it's not unlimited like it used to be, but it has increased from 10,000 to 40,000, much more generous. It does have an income limit though, because if you make more than $500,000, you can only do the $10,000 SALT limit. So it's still a little bit of a limitation for very high income earners, but for most Americans, the 10,000 goes to 40,000. So that is good news for most of you who are listening to this. And it seemed to be a good compromise between Democrats and Republicans, although Democrats didn't vote for this bill. This was sort of a bipartisan element of the tax law. Another thing that we're going to talk about, Brett, is the no tax on tips and overtime. This is something that was a campaign topic pledge for President Trump when he was out on the campaign trail, and he did deliver on this promise. So let's talk a little bit about no tax on tips and overtime.
Yeah, sure. Let me just bounce back to the salt deduction really
Oh,
quick.
yeah, please. Yeah.
Let me just add one more thing on there. So the main number here, like Chris just said, is going to be that $500,000 number of adjusted gross income. So that's going to be your income minus any deductions that you take. So the one thing I'll just mention to be cognizant about is if you are doing any type of Roth conversion for the year, be very, very cognizant of how much Roth conversion that you do. So it doesn't push you over that 500,000 adjusted gross income limit. That's when you start losing your SALT deduction. So just keep that in mind when you're considering doing Roth conversions. That way you don't miss out on those benefits.
Yeah, that's a great point. Thank you for adding that.
So for the no tax on tips and overtime, this is going to run as it stands right now from 2025 through 2028. It's capped at $25,000 of income per year. Anytime you go over $150,000 of adjusted gross income, that amount, that $25,000 amount will be reduced. So also another thing you need to be cognizant of, it's not a unlimited tax and tax on tips and overtime. So you can't go out and earn unlimited tips and be untaxed on them or work unlimited overtime. It doesn't work like that. So the magic number here is really going to be $25,000, which I think is a great positive overall for the year.
Yeah, and I think to be fair, this legislation is a little cute. They offer this for the first time, no tax on tips with the limits Brett just explained, from 2025 through the end of 2028. But what we've seen over the history of tax policy and the way Congress and now politics work, it puts a lot of pressure on whoever is in power next to not extend this, because if they consider ending this, they'll be accused, rightly so, but they'll maybe get beat up on it about raising taxes on people that rely on tips and overtime. So they were kind of cute. This made it budget friendly by saying they only did it for 3 years. When you look at the forecasting that's done with tax policy in this country, they definitely are cute with this by doing it only for a couple of years, because the next people in power will have a hard time ending this. So I would bet that this gets continued beyond 2028, and this little cute trick actually will work out and this gets extended. What do you think, Brett?
I think that's a really good way to put it because if you were to turn on the news and watch the headlines, no tax on tips would be portrayed as unlimited. So I recently had a friend reach out who is a firefighter who works a lot of overtime. And he was really excited. He says, "Wow, all my overtime now is going to be tax free." I said, "Well, I hate to be the guy that burst your bubble, but it's only up to $25,000 per year." So I think a lot of people actually don't know what the caps are because it was sold in a cute way.
This isn't a political show, but that's a little political insight for you, those that are listening. Uh, the final thing I want to talk about is immediate expensing for businesses. Earlier in the conversation, Brett, I talked about I think that the simplification element of the first tax law was underreported. And I think in this bill, the one big, beautiful bill, which is now law, I think the underreported item that I would identify is immediate expensing for businesses. So I just mentioned it's not a political show, but if you think about the Trump administration's policies, one of the major themes is to try and bring manufacturing and jobs and supply chains back to the United States. We could debate whether that's right or wrong, whether how he's going about it is good, bad, whatever. But that's a major theme of the Trump administration. And one of the ways they have expressed that is to allow businesses, including things like research and development and expenses for operations, to take those expenses right away on their tax return. So what you want to appreciate, listener, is that how it works now is, say, with research and development on, say, a vaccine or some biopharmaceutical product or even something in the technology space, you put out money, you pay people, you do research, it's expensive. And let's say it costs $1 million, you can't necessarily take that $1 million and deduct it on the tax return. It's something that you depreciate over time. Depending on the item, it could be 5 years longer. We're not going to get into the weeds on that. But what this law now allows is immediate expenses. So the government is trying to make it easier for businesses to invest in their business and be able to deduct items completely on their tax return, which matches with their cash outlay. They spent the money, now they could deduct it right away. So it's very business friendly, and it seems to me is very cohesive with this major theme the Trump administration has. Did I explain that okay, Brett?
Yeah, definitely. I think it's going to be really good for small, medium-sized companies, really stimulate investment in themselves. That way they can foster more rapid growth. I think it'll help a lot.
So we're going to end part one of today's episode. As I said at the beginning of the show, please check out part two. To review, we talked about immediate expensing for businesses. We talked about the extension, the permanent extension of the personal and business income tax rates and brackets. We talked about the child care tax credit. We talked about the standard deduction. These are really important things that you will see if you pay any attention at all to your tax return. We think these are positive things by and large. And on the next episode, part two, we're going to talk about the Trump accounts, which are new, the expansion of 529s, and some of the charitable deduction changes in the one big beautiful bill that is now law. Thanks for listening to Brett and I on this episode of the Simply Financial podcast. We'll be back with you very soon on the next episode. Have a great day.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.